Welcome to Currency Cast. How can we account for the rise of the Swiss franc? What are the factors that explain the strength of the Swiss currency? And more importantly, what can corporate treasurers do about it? Welcome to Currency Cast. My name is Agustin McKinley. I'm the senior financial writer at Cantox and your host. In this episode, we have the pleasure to welcome Costa Vayenas, Chief Investment Officer at Genesis Investment Partners and author of The Swiss Franc from 1798 to 2055. A very good book. Costa Vayenas, thank you for joining us today on Currency Cast, and a warm welcome to you.
Thank you very much, Agustin, and thank you for inviting me.
Well, Costa, can you start by introducing yourself to our audience, please?
Yes, I'm Chief Investment Officer at Genesis Investment Partners. We're based in Zurich. We serve first-generation tech entrepreneurs and curated families in that space.
Right. Now, let's devote the first part of this conversation to the Swiss franc from 1798 to 2055. There we have it. It's a very good book. I reviewed it on LinkedIn. The author is at home with both the uncovered interest rate parity theorem and classical philosophy. So that's tour de force, right? Now, one thing that strikes us as readers is when you think of non-fiction books, you usually think of, say, of biography or a book on history, on politics, and so many other subjects. But it's not that often that we see a book on currencies. Perhaps the US dollar is an exception. We have this year at least two good books on the US dollar, are Dollar Your Problem by Ken Rogoff and King Dollar by Paul Bluestein. But it's even less often that we have books on the Swiss franc. And so my first question regards motivation. What are the main driving forces that led you to write the Swiss franc from 1798 to 2055?
Yeah, thank you, Agustin. So my background is as an analyst, and I'm always interested in data and charts and kind of recreating data series. And I noticed about a year and a half ago that I was the only one on the internet who'd recreated the Swiss franc to around 1850. And so I thought, why is that? And then I wanted to, find, what happened before 1850. And I discovered that it was very hard to find that information. And I approached the Swiss National Bank, which prints the Swiss franc. And they were very kind and said they'd help me and look for data in their archive. And they said I should send them a list of questions. And so my first question was, what was the value of the Swiss franc in US dollars in March 1799? And then there was silence for a while. And then they got back to me and they said, well, we don't have data in our archive on what the questions that you're asking. And then I said, well, I know there was trading happening. We have history and information, so I'm going to find this information. And that was the trigger to kind of look for this data. And so first to create the database and then to tell a story.
Right. Now the book is not very long. It's about 176 pages, but it's richly illustrated. There are 62 illustrations. I counted 50 charts. And as you said, some of those charts go back decades in time, some of them even centuries. And there's one that takes us all the way to Babylonian times. So tell us a little bit more about that research process.
Yeah, so for more than 10 years, I've been building up a database on historical interest rates and exchange rates. And the Babylonian one looks at the lower bound of interest rates across 5,000 years. Mm-hmm. So we have history, we have data on interest rates by collateral. The best collateral was gold, then second was silver, and the third was an agricultural commodity such as barley.
Right.
So we have the data that shows us what was the interest rates in these different empires and countries, and I recreated the minimum rate over 5,000 years on a chart, and that appeared in the Financial Times. So I was always interested in doing this kind of research. And the same happened then with the Swiss franc. When the central bank told me they don't have the data, I started to look for it. And it is amazing what data is not on the internet. There is so much in libraries, great books, and in archives. And I found a book, four floors underground in the Central Library of Zurich, a handbook of foreign exchange rates from the 1500s. Yes, so you see all these nice things hidden underground, and that set me on a path. And then I found more. So the next thing was to digitize this, to make this easier to work with.
All right. Now let's go back to present times, and why don't you take us through the series of factors that, up to the present, help to explain the strength of the Swiss franc. I'm thinking here of maybe neutrality, geopolitics. Tell us a little bit more about all of this.
Sure. So let me just say, I mean, at the most basic level, for any currency in the world, you have supply and demand, right? If there's more demand than there is supply, then the currency will go up. And this is what we have with regard to the Swiss franc. And the question, therefore, is, so why is there more demand than there is supply? And when you look at supply factors, so before neutrality and all these things, when you come to supply factors, you can see, first of all, there is a balanced budget over the cycle. It's in the Constitution. So there is relatively low government debt. If the balance cycle continues, the debt will eventually hit zero, right? So there's less demand, less supply, just from say the fiscal story. And then in terms of inflation, when you look at most central banks have an inflation target of 2%. I think ECB, Fed, and the Swiss central bank has a price stability target of 0 to 2. So let's assume that the Swiss central bank hits the midpoint of its target of 0 to 2, which is 1. 2 minus 1 means you have a gap of 100 bips per year. So just in terms of how different central banks are positioned, mechanically, mathematically, there's going to be more of the one and less of the other. So that's one important factor.
Right, and you say in the book that over time, this is when such differences count, right?
Yeah, they add up. 1% or 1% or 1%. Over time, they can add up. And of course, the market anticipates this. Now, on your question of neutrality, so I look at all these different factors in this book. When we go back to 1798, I think what helped Switzerland at that time was it was spared the wars that affected the neighboring countries. The neighboring countries were monarchies, absolute monarchies in many cases for a long time, and those monarchies had huge expenditure, nice palaces. They subsidized great composers and writers, so they were very cultured, and the Swiss didn't have that big expenditure. And the other thing is these monarchies often were involved in wars, defending their territories, and war is very expensive, and so Switzerland was kind of left out of that. And so that obviously is an important factor. If you can work without being disturbed, if you can make your watches and nobody's invading, then you can make more watches than if you have to stop and fight. So that helped, certainly helped the the context of, okay, so here is a country, it's not participating in wars, not participating because the neighbors didn't want it to help the other side, right? So the neighbors would sign contracts saying, you don't fight with anyone else, you stay with us or you stay out. And so it was a neutrality that was actually kind of enforced. It wasn't that the Swiss were born with a neutral gene. It was that the outside world said, we don't want you to allow people to travel through your passes, etc. Right. So that obviously had a factor, and specifically with regard to currencies, when the Swiss franc was originally created, it was a metal coin, silver. There was no banknotes. This was very different to some of the neighboring countries. Some of the neighboring countries used paper as well. And so from time to time, you would have the suspension of convertibility from paper to gold.
Right.
So for example, even the Bank of England suspended convertibility.
In the Napoleon Wars, yes.
With Napoleon Wars, exactly. And the greenback, there was suspension of convertibility during the US Civil War. So here you have a dollar, but you can't convert it into gold. So it wasn't a real gold system. And in contrast, Switzerland didn't have paper, just had these coins, which was one factor. And crucially, didn't have a central authority. They had many cantons, and each canton wanted to have their own coins.
Right.
And so that acted a little bit as a firewall between cantons. So if one canton messes up with its currency, it is a firewall against the whole country, right? Whereas in France, after the revolution, when they started printing paper money, they had hyperinflation across the whole of France. So the fact that Switzerland had these little pieces acted as a break. I mean, it had other inefficiencies, of course.
Right.
But I'm answering your question about the origins. Absolutely. And what kind of made it a place where people thought you can keep your treasure.
Right. That's really interesting. I guess it takes us to one of the main points of the book, the issue of jurisdiction. There are a couple of very important sentences. One is jurisdictions matter, and what you discuss here is the independence of the Swiss National Bank, and more broadly the rule of law and the trust that it creates in terms of the performance of contracts. So please explain a little bit more in detail why that matters so much.
So in contrast to the situation that we have in the United States, Switzerland has no prime minister and no head of state. And so there's no one single person who's able to make very big decisions on their own. There are committees, there are groups. And specifically when we look at the policy of the central bank, and again, I'd like to contrast it with this very strong executive in the United States, where the president he can express his views, of course, on monetary policy, and that sometimes may create an expectation in the markets. If you look at the Swiss legislation, the instruction in Swiss law to the Swiss central bank is you are not allowed to ask anyone, and number two, you are not allowed to take advice from anyone.
Right.
By anyone, they identify them as this government agency, this government, this cabinet, these government officials, right? So now you say, oh, they have that in the law, and would they ever need that? They don't need that, do they? But now we see with the United States, perhaps one day you might need it. And so at least here, FX is relative, right? You relative supply and demand, relative inflation differentials. It's all relative to something else. And so relative to the United States, it is just a little harder to put political pressure onto the central bank. I don't know if it is, secretly it may be possible. Anything's possible, but it's just so much harder. There is no prime minister, there's no head of state, there's no one person who could pick up the phone and tell the central bank, this is what I think is good.
That's right.
So
Yeah.
That is a firewall. And the market, when you look at the kind of forward rates, the market appreciates that or builds it in.
I guess I was about to take it there. I guess that helps to explain the high forward premium of the Swiss franc. We're talking about almost 4% to the US dollar in 1 year forwards. We'll come back to that a little bit later on. But let's stick to the issue of jurisdiction. But because then in the book there's yet another mention of the jurisdiction issue. But now, instead of being centered in the past and the present, you take it to the future. And it's a very bold step. You say jurisdictions will continue to matter, even in the world of tokenized and private money on a blockchain. So tell us a little bit more about that.
Yeah.
Why those also the matter of jurisdictions into the future, and of course the future of the Swiss franc.
Yes. So why jurisdictions will continue to matter in the digital world, digital currencies, digital assets is at some point the digital assets meet with the fiat world, right? At some point that interaction happens, and the people who own digital assets live on this planet. They travel around, they meet to go to airports, and the jurisdiction where they choose to reside in determines their tax, right? And let's suppose they live in a completely tax-free jurisdiction. There may be inheritance taxes linked to that. Anything's possible. The law keeps changing. So there is this interaction between the digital world and the fiat world. And the question then is, okay, so, where do you think your digital assets will be better protected as well? Where they're likely to be taxed away, confiscated. Things change. And the point about jurisdictions, therefore, is just, let's think about, so we haven't escaped by owning, something that's doing well in the digital world. We haven't escaped where we live, where we plan to live, where we're going to retire. How do we give this to our children, perhaps, right? So there are many factors that interact with the real world, which makes jurisdictions really important. And it also comes back to my chart of 5,000 years of interest rates, which is you could see which jurisdictions ended up having lower interest rates over time. And they tended to be places where capital was flowing to. So that was kind of the connection. And it was, just to address the argument that we can escape the real world by being fully digital somehow in our assets.
That's a great idea. I really enjoyed that one when reading the book. Costa, let's discuss the resilience of the Swiss corporate world, Swiss companies in the face of the seemingly unstoppable appreciation of the Swiss franc. At Cantox, we are every day developing solutions for, to tackle that issue, that the high forward discount or premium of currencies, and how to help corporate treasurers manage those interest rate differentials, be it in pricing, in hedging, in swaps, and what we mostly is by using API connectivity to create a corridor around the exchange rate and delay as much as possible execution of hedges. As each day that passes by, that shrinks the difference between the spot and the forward rate and diminishes, in this case, hedging costs without, of course, not losing sight of the risk management. But you mentioned in the book, in that, not exactly in that regard, but in terms of the resilience of companies, the fact that so many Swiss companies are among the most innovative ones. I think the country ranks number 1 in the Global Innovation Index. And also, you discussed the strong export focus. So let's talk about this. Innovation, the export focus and the resilience of companies in the face of the strength of the Swiss franc.
Yes. So there's several factors here. So the first, I think, the Swiss franc affects the mindset of Swiss companies. And what is that mindset? That mindset is, and if you look at the chart on the front page of the book, the currency is moving in one direction over a long time, right? And so we cannot, it's, this is the fewer and fewer Swiss francs to buy $1. So the trend is clear. And the question then is like, so how are we going to make money? How are we going to survive? How are we going to export? How are we going to sell our stuff if that's the trend? Because what we know is the central bank is not going to help us. Central bank is not our friend in terms of helping the exporters, right? Of course, there will always be some lobby that tries to, in other countries, you can lobby the president, you can lobby one person, and something might happen. You can lobby the prime minister. In Switzerland, who will you lobby? It's hard to find them and put them in one room. So the central bank is unlikely to be the friend of exporters, and that's what history shows. So then you need a plan B. And the plan B is, okay, so let us produce stuff that we think we can sell and people will be willing to pay, right? And when you go back in history, like the first product sold in China from Switzerland in the 1700s was watches.
Watches.
Right? The imperial dynasty, the house there, they liked the watches, they bought them. So that's how the business started. And so you can see that you need to find products that you can carry over the mountains. Switzerland has no access to the sea. And you need products that people, when it reaches there, will survive and stay, and they'll be willing to pay for it. So that mindset influences everything that when it comes to Swiss production, exports. What should we base here? What is the Swissness element, and what can we base somewhere else, right? So that mindset, I think. In many countries, I don't see that mindset. But here, that mindset is really, really strong. And you can see that in terms of efforts at automation are very strong as well, right? So to give you one small example, in many countries, when you go
We like that, when you use the term automation.
Yeah. In many countries, when you go to the supermarket, there's somebody who's going to pack your bag for you or help you. Here there's nobody. You have to do that. You have to scan, you have to do that. In many countries, when you go and fill up your car with petrol, there's somebody who will help you or do that. Here you have to get out of the car, do it yourself. So that mentality of like, we can't afford expensive people. We have to find some automated way. We have to do something else. We have to cut costs. That is very strong in the mindset of everybody, farmers, and at all levels.
Right.
And so your products will be of certain people will be interested to hear how you can help them become even more efficient, because as you say, I mean, the trend is clear, and there's this gap. Do you hedge it? At what price do you hedge? To hedge at 4%, that's a lot. Right?
That is indeed a lot. And say at 12 or 13% against the Brazilian real and others. Now, continuing with this idea of the resilience of Swiss companies, you also discuss in the book one topic that is a favorite of mine, the cost of capital. And here, maybe a short comparison with Argentina is so interesting. If you think that jurisdictions do not matter, well, look at Argentinian bonds, right? They yield 3% more for comparable securities in a local jurisdiction than in bonds issued in New York. And if we continue the comparison, the Argentinian currency, believe it or not, has episodes of strength in markets. But here's the problem. You have, as an Argentinian company, during those episodes of a strong currency, a high cost of labor, but it's coupled with a high cost of capital. And that is totally unsustainable. You cannot have both a high cost of labor and high cost of capital. It's going to create a perpetual fiscal crisis, as you never be able to collect enough taxes to offset that impact. So you say in the book that the idea of course, the Swiss National Bank independence, the low inflation expectations, helps companies and in terms of the low cost of capital. Tell us more about this.
Yeah, sure. So you can see a strong currency also brings benefits, right? So we've just discussed what are some of the problems you need to worry about being efficient and all that, but it also brings benefits. If the market believes that the currency is likely to appreciate over time, then the market is willing to accept a lower interest rate because the market thinks it's going to be compensated through a stronger currency over time. As you mentioned, the interest rate parity hypothesis, right? Which that interest rate parity hypothesis comes back over centuries. It's not something new. We have it from a century of data between sterling and the French franc, for example. There's no free lunch over the long term, right? So there has to be some kind of compensation. And the compensation here in Switzerland is that for this appreciating currency, you're going to get low interest rates. And current interest rates are zero. Central bank policy rate is zero. So that sets the base. Everything above zero must represent a premium to something. But that's a good start. So capital costs are low from that perspective. It then feeds through the whole economy, right? If the government can borrow at zero,
Right.
if I think the 30-year bond is 0.3.
Yeah.
If they can, it means they need less tax money to pay interest service, right? So what does that do?
The debt break.
Yes. So what does that mean? That means even if the government can borrow at zero, there's a lock preventing politicians from going crazy, right? So the fiscal situation remains kind of pretty good.
Absolutely.
And that keeps interest rates down, it keeps inflation down, keeps interest rates down. And that is the compensating factor that's very helpful for corporates.
Now, Costa, you do mention another benefit of the strong currency, and it reminds me of the saying by, I believe, the Swedish economist Abba Lerner: if you want to export, you need to import, right? And yes, of course. I looked at a recent report by Sika, a chemical manufacturer there in Switzerland, and they say, well, we have a bit of a currency headwind in terms of our sales, but remember, we import, the cost of inputs goes down, so that's another, a compensating effect, is it not?
Yeah, so that's very powerful. So what it means is your imported inputs tend to become cheaper and cheaper in Swiss francs over time, right? And that's very powerful because it means it gives you advantages. So for example, let's suppose you're producing chocolates. If you're able to buy cocoa at a lower price, or at a lower price in Swiss francs, you might, because of the mentality issue, you might be persuaded to buy the best cocoa on the market, right? So you're like, okay, we're going to produce chocolate, we're going to compete with Belgium and many other interesting places. what can we do? Okay, you go for the best cocoa on the planet. And so that's one advantage. Another advantage is if what you're paying in dollars, for example, for American software, and you're paying in dollars for advertising on Google or wherever you're advertising, those dollar costs come down every year in Swiss francs. What does that mean? It means for the same amount of Swiss francs, you can buy more advertising, right? So
more technology, more software,
more all of that, all of that, right? So it has this reinforcing effect that makes you more competitive, or makes you want to be more competitive, or you have to be, otherwise you're going to go out of business. So these factors are very helpful.
Yeah, that's well. Look at one of the most interesting parts of the book. All of those reinforcing effects. Costa, let's talk a little bit about the Swiss franc and gold. Yeah, I take it that there was a recent article in the Neue Zürcher Zeitung about your book. Is that right? And correct me if I'm wrong, but I think that in a passage of the book you say that if you take compound interest, so the Swiss franc currency does very well even against gold, which is of course one of the star assets in recent years.
Yes. So this was just to show, there's this general view that says, gold outperforms everything. Gold is so much stronger than currencies, and of course there are long periods when that's the case. But I just wanted to show from 1836, which is when I was able to get interest rates, until 2025, this year in which gold did so well, the Swiss franc, including interest rates on an ordinary cash deposit, outperformed gold over that long period. Why is that? Because you got compound interest. Of course, it was just an illustration, because we don't make allowance for tax, but just to show you that you can over certain times get outperform gold over very long periods. And then there's an interesting phase. There's an almost 20-year phase in the early 90s where if you took Swiss francs and you put it under your mattress, so no interest, it outperformed gold over that period as well. So obviously, the long-term trend in gold is up. I'm not arguing against that, and gold is a great asset and an important asset to hold. But I just want to show that there are phases, and they can last for a long time, of outperformance, underperformance. And of course, now we're very clearly in a very strong gold phase.
Right.
But I just wanted to illustrate that what history showed.
Yes. Now, when I finished the book, I couldn't help but notice that it was published in Wrocław, or whatever, in Poland. And that's very interesting, because it led me to a statement, I think, on page 103. Source what can be done more cheaply elsewhere. So tell us a little bit more about that story.
Yes. So, this is the beauty of the market, right? I discovered late that the book is actually published and printed in Poland. Printed in Poland, which was first of all a great surprise, but secondly also made me realize, well, it's kind of obvious that, Swiss printing costs, I'm sure, are a lot higher. Swiss labor is more than elsewhere, and all these things. So I'm extremely happy that the book is printed in an efficient market for printing. And I didn't know that, I didn't choose that, but that shows you how the market can be super efficient in terms of fine, you're going to do a book, this is done by this provider, this is done by that provider, and here's your book, and then you look and you see, oh, it was printed in Poland. That shows the efficiency of markets as well, right?
That's right.
There are clearly areas in which Switzerland is not efficient, and it can be very irritating, and part of that is agriculture. Another example is printing costs. So that means, you're forced to just find the most efficient route.
That's right. Now, I take it also that, as now taking a broader view, that you traveled recently to Poland, speaking of the book being printed there, but you were also quite pleasantly surprised by the way this country is evolving. We ourselves at Cantox have just opened an office in Warsaw. So
Yes.
discuss a little bit that the Polish story for us
Sure.
from your
So,
perspective.
sure. So I didn't mention that before I worked at UBS for 25 years. I covered emerging markets, and Poland was part of that space because it happened to be in the index for some of the assets. And so I always visited Poland and kept an eye on Poland. And it is remarkable what has happened there in terms of the growth, and the entrepreneurial spirit in Poland is extremely strong. And you can see a return of confidence by Polish businesses that they realize that they have discovered how to make money in a very great way. And they're expanding and growing. And it's a wonderful story, actually. What is also of interest, what has also been of interest is, Poland has its own currency and has kept its own currency. One of the reasons that they liked that was that, whenever you have a financial crisis or a crisis, which we saw earlier, the currency can act as a shock absorber, and that helped the economy in previous times. I was just wondering, though, on my recent visit, I was invited to a conference, as you mentioned, that was in Warsaw. It was obvious that inflationary pressures were higher than in the euro area, and the inflation peak was higher than the euro area. And so you can also see some of the downsides of not sharing the single currency. The upsides are clear: independence and shock absorber. But some of the downsides mean that you have higher interest rates and perhaps higher inflation expectations. And so one of the themes in Poland, despite that very positive story, was people talking about the appreciating real effective exchange rate of the zloty is up quite a lot.
Right.
And they feel that. And so they hear the Swiss franc story, but they don't see how that immediately could apply to them, because the real effective exchange rate moved up so quickly. And they're like, okay, so this is how we built our system, and now we're suddenly going to export at this higher level. So it's a challenge in Poland.
Yes, it is. Yes, absolutely. Costa Vayenas, Chief Investment Officer at Genesis Investment Partners and author of The Swiss Franc from 1798 to 2055. We've covered a lot of ground. I would have liked to continue this conversation, but we don't have that much time anymore. We discussed the books, the story of the Swiss franc, the factors behind its rise and rise. We discussed the comparison with gold and what Swiss companies could do in the face of the appreciating currency. So it was a broad discussion. Is there something that you would like to add, Costa?
Well, a general statement I would make is that the book found interesting data in the archives, and so there's lots of interesting books and things in the archives. Don't ignore the libraries, don't ignore the archives. Not everything is on the internet, and there's some great opportunities to look for interesting aspects there. That would be one factor. And the second factor I'd say is all entrepreneurs can think about how to improve efficiency, and because as we see in the case of Poland, the real effective exchange rate could move very suddenly, and so thinking about costs and what you can do to become more efficient is something that all of us can do. Right.
And on that note, we are going to leave it here, but I'm sure we'll have another opportunity to talk to you. Costa Vayenas, thanks a lot, and see you soon.
Thank you so much, Augustine, for finding me and for reading my book. Thank you.